U.S. natural gas futures held steady on Friday, supported by a rebound in LNG export flows that helped offset forecasts for milder weather and slightly lower demand in the coming week. Despite the small gain, prices were down around 2% for the week, adding to the previous declines of 9% and 3% over the past 2 weeks. Meteorologists expect temperatures across the lower 48 states to remain warmer than normal through at least July 26. Daily average temperatures are expected to peak at 81 degrees Fahrenheit on July 15 and 25, marking the highest level so far this summer but still below the 2022 record of 83 degrees Fahrenheit. While such heat typically boosts gas demand for power generation as air conditioning use rises, the market continues to grapple with robust supply and elevated storage levels. Despite the above-normal warmth this summer, analysts project that energy firms will continue injecting more gas into storage than usual. U.S. dry gas production hit a record high of 106.4 billion cubic feet per day in June and has averaged 106.6 so far in July. That said, daily output recently declined to a preliminary 105.7 billion cubic feet per day, a drop of 1.9 billion cubic feet over the past 8 days. These figures may be revised as more accurate data becomes available. Total gas demand in the lower 48, including exports, is expected to rise from 107.3 billion cubic feet per day this week to 108.4 next week, before dipping back to 107.3 billion cubic feet per day. However, the updated forecast for next week is slightly weaker than earlier projections, tempering expectations for a near-term spike in consumption. Storage remains a key bearish factor, with inventories currently about 6% above the 5-year average for this time of year. Many analysts expect the surplus to expand further in the short term. However, rising LNG exports could help chip away at the excess later in the year. Feed gas deliveries to U.S. LNG export terminals have recovered to an average of 15.7 billion cubic feet per day in July, up from 14.3 in June. Daily flows climbed to a 12-week high of 16.3 billion cubic feet per day on Friday, with output at Cheniere Energy's Corpus Christi terminal alone rising from 2.2 to 2.5 billion cubic feet per day. Meanwhile, pipeline issues are adding minor supply-side disruptions. Kinder Morgan's Tennessee Gas Pipeline declared force majeure at its Station 110 facility in Kentucky due to equipment repairs, potentially affecting up to 0.67 billion cubic feet per day in flows starting July 12. From a technical standpoint, natural gas is attempting to consolidate following several weeks of selling pressure. The market has found support near $3.30, and resistance is forming in the $3.50 zone. A breakout above this range could trigger a move toward $3.75 if LNG flows continue rising or weather models shift hotter. On the downside, a break below $3.30 could lead to a retest of $3.15 or even the psychologically important $3 level, particularly if storage builds remain strong and demand softens. For now, the market remains range-bound and directionless, awaiting a stronger catalyst from either the supply or demand side. Please like, subscribe, and comment to support the channel. See you in the next one.